Okay, good morning, everyone. Today we have, we're going to chat with Marcus Lepp. Marcus is with the Bank of England, and he is a mortgage professional, and he's agreed to come on and talk to us about what's going on in the mortgage industry these days in response to the virus crisis that we're in, and hopefully give us all some good tips. So now, Marcus, tell me a little bit about who you're with and what your position is there.
Bank of England Mortgage is the mortgage company that I have been a part of now for going on 4 years. And my position is one of many hats. So run the operations, hire, recruit, problem solver, fireman, coffee maker, repairman, you name it, I do it.
What sets y'all apart from, because there are a lot, I mean, the market's just flooded. It seems like there are a ton of mortgage brokers, a ton of banks that handle mortgages. What sets y'all apart?
Well, we've always specialized in white glove, VIP, boutique type of service. So we're not a massive call center where someone's going to, call in and you may talk to various different people every single time that you want to get a hold of somebody. All of our loan officers and processors and loan professionals that are working on each and everybody's individual loan is available, via text message, cell phone, email. We know you by name. We've worked with you many times. A lot of our clientele are repeat clients, and we've done numerous transactions with them in the past. So we're able to give a higher level of customer service than some other places. So that's what I feel sets us apart from the norm, along with we really do have virtually every single loan program available that you could find at a small, local bank or a, very large lender.
Well, it seems to me just during this climate, because I just went through the application process through, out of the CARES Act, and having that small, because I have a small bank, a personal relationship with my banker that provides the same type of service. So it seems like it came in very handy. I mean, it was a game changer for us because I had that personal touch and that relationship and that white glove service, and it made a big difference in having to deal with a larger corporation. So it seems to me, especially during the COVID-19 era, that having that personal touch can really make a difference for the consumer.
Well, I mean, there's a massive amount of uncertainty right now. Mm-hmm. And that is typical whenever there is a heightened stage of let's call it crisis, right? Mm-hmm. And having a direct line to someone who is involved with what's going on, knows where your loan is during that process, can answer all the what if questions whenever they arise, I feel is a huge piece of customer service that you can't get at your larger lenders. So it is nice. I would say if I was a customer, this is the type of place that I would want to work with.
Right. And just having that personal relationship with someone that can guide you through the process, because like you said, especially, at our clients in the family law industry, there's so much uncertainty right now. And where we as business owners can give them some certainty, I think we help kind of reduce the chaos, and because things are chaotic. Speaking of the chaos that's going on right now, a lot of people are finding themselves in a situation where they really need to be able to either have some financial relief, and at some point, because some people are losing their jobs or being laid off, or they're not sure what's going to happen maybe 2-3 months down the road. So I'm hearing a lot about forbearance, mortgage forbearance. Can you tell us a little bit about how that works, what the pros are, what the cons are?
Yes. So the mortgage forbearance that a lot of people are going to um, think about when they're hearing about it in the news, or maybe they're receiving emails or written correspondence from their lender, is in the event that you have suffered a change financially for the worse, where you may not be able to make your mortgage payment. You are able to defer your payments until a later date. That's what forbearance is. So the pros of that are you don't have to worry about necessarily falling behind on your mortgage payment and suffering through worrying about losing your home at the same time that you can't afford to make your payment. That is definitely, I would say, a pro for anybody that has unfortunately lost their job over the past couple weeks or months, and it's a resource for them to at least get a temporary reprieve for their current situation. The cons, unfortunately, outweigh the pros. It will impact your credit. So we've already seen and have seen in the past where somebody who's looking to refinance is currently in forbearance, and it shows up on the mortgage trade line on your credit report that the loan is in forbearance. And if your loan is in forbearance and you haven't been paying it back for a minimum of 12 months, there's nothing that any conventional lender can help you with, unfortunately. So that also impacts your credit score. So what it's going to do is basically report to the credit bureaus as a non-payment because you're not meeting the arranged agreement, and that's going to impact your score. And then the other piece to that is what happens after the fact. So when you go return back to work and you're able to make your payments, there's going to be a large sum of amount of payments due, and the agreements are all written the same. And basically it is due as a lump sum. Now, for a lot of people, that's unrealistic. So what happens is they'll give you 12 months to divide that up and pay it back along with your scheduled mortgage payments. So it's very hard, and it can actually put you in a worse situation than if you struggled just to maintain your payments and cut back on some other things.
Well, what about if someone is, say, asking for a forbearance, but they're already behind on their mortgage? And how does that affect? I mean, and now that COVID-19's hit, they're thinking they might need a forbearance. How is that going to affect them? Are they going to be able to take advantage of anything like this?
If they were already behind on mortgage payments, no.
Okay. And what happens to, like, say, if they have escrow, they escrow their taxes and their insurance, do they still have to keep paying those taxes and insurance while they're in forbearance?
Well, the taxes and the insurance are, and when you say escrow, are held in a separate account. Okay. That the mortgage company will disperse all at once, one payment for your taxes, one payment for your insurance. And that too will fall behind if you do escrow your payments, or include the taxes and insurance into your monthly payments, because when it comes time for those taxes to disperse, the mortgage company will pay, and they will pay the insurance and they will pay the taxes, but that's going to show as a negative balance that you also have to catch up.
And so it could result in your escrow payment the following year going really, really high, correct? Or a lump sum being due and payable.
That's right.
Is that right?
That's
okay.
Right. Now, some lenders, some we'll say servicers, not lenders. Some servicers, they understand the severity, and they don't want, and I want to clarify and make sure that all of our listeners understand that no mortgage company wants to foreclose on somebody. Correct. That is not healthy for economies. That's not healthy for us. Nobody wants to take the house away. So the main thing is each servicer is going to have their team assess what's going on and try to at least get something worked out. There have been companies that will do longer than a year to allow you to repay. But through that repayment program, if you miss one payment, it can have a tremendous impact for the negative, meaning that you could end up in a foreclosure situation.
Now, I don't know why I was under the impression, I thought I'd heard somewhere, and I'm going to go to different options, but this is a curiosity. I thought I'd heard somewhere that lenders were not allowed to report this on your credit if it was due to COVID-19, or that it would not have an impact. So is that an incorrect
They're going to
assumption?
report, so here's the thing. Whether they're allowed to or not may be the case. And first things first is they're going to protect themselves.
Correct.
And one way to do that is they will report it to the credit bureau. Now, if you work with, a specialist that you call in and say this was due to, COVID-19, here's the documented proof, it's possible they would remove it. But knee-jerk reaction and on a massive scale, they can't individualize. If a servicer has, let's call it, 1 million customers, they can't just individually break one up and say, okay, we're going to put this one in this type of forbearance or this one. It's just going to be blanketed the same action across the board. Whether it's right or wrong, unfortunately, just can't be siphoned out at the moment.
What about other options, or are there other options that people can take right now to either get some relief, either on their payments or maybe some equity out of their home? Are there things that they can do to take advantage? Because most of us, our main asset is our home.
That's right. That's right. It's your most important investment. And that's one thing that, I did want to make clear on the call is that even on a hierarchy of what comes first, in a survival type state, the main thing that you need is shelter.
Correct.
And, that is also taken into account with the credit bureau. Is your house payment, your rent payment, whatever it is, should come first before anything else, because that's the roof over your head. So maintain your payment no matter what. The forbearance option should be a last resort. And, some other things that you can possibly take a look into would be, number one, if your income has declined, but you haven't completely lost your income, setting a budget so that you can make the payment. Maybe you get paid twice a month, and during that twice a month, you separate maybe 15% of that for groceries and utilities. Mm-hmm. And then the other portion of it, you set aside for your mortgage payment, so that by your second paycheck, you've got enough to make your mortgage payment. And you've got, the other 15% set aside for other needs. Right. So that's one, smart way of dealing with it. It does get difficult to plan these things strategically as, you're in a state of panic. But, one thing that if you are eligible to refinance, that definitely will help anybody here, is if you refinance, whether it take equity out of your house or just lower your interest rate, you will skip a mortgage payment. Now, the money that is owed still gets paid. So it's not a just payment forgiveness, but between paying off one loan and setting up the servicing on the new loan, there's usually about 2 months that if you plan it the right way and you work with the right company, can be timed to where you skip 2 months payments. And then before your first payment's due. So for example, if for our customers that are closing right now that were in the mortgage process soon enough, we said that if they wanted to, they could hold on to their April payment, and that when we closed, they get to keep that cash. And then their May payment, they don't have a mortgage, because during that time, we're setting up the new loan for them to make payments to in service. So they don't have a payment due in May. So for April and May, that's 2 months mortgage payments that they can keep for, let's call it, emergencies. And then if their mortgage included taxes and insurance in their payment, that escrow account is what we call it. They get that money back too, because we have to set up a new escrow account during the time that we're refinancing. So that money that's already set aside in another account comes back to them after they close out the mortgage that they were currently on. So during this time of year, we've got at least 4 months of what your property taxes are in there. Potentially, 4 months or more, maybe less in insurance. And let's say that that all adds up to about $3,500 when it is paid off, or your mortgage, your current mortgage is paid off. That $3,500 in your escrow account set aside for taxes and insurance would come back to you. And then you can compound that into, emergency savings with the 2 months payments that you didn't have to make on your mortgage.
Okay, so that's a way of accessing some cash, just a straight up refinance. Maybe they're lowering their interest
Straight up
rate.
refinance. Because even if, for our local area, let's call it Dallas, Fort Worth, Collin County, most of the mortgages that are out there are between 180 to, let's call it, 250. And between that, they could be less, they could be more. I'm just, on the average here. And then if you're able to, reduce your interest rate from, let's call it a 4.25 to mid to low 3s, you're going to get payment savings. It may not be, more than $100 or $200, but you're going to get payment savings. You're going to lower your payment, and you're also going to get cash savings from doing the refinance and getting money back. There's also getting equity out to pay off credit cards,
Correct.
to pay off maybe a vehicle. And, one thing I definitely want to share with everybody, and a misconception that people have, is paying off a car loan through a refinance is basically taking your car and financing it over 30 years.
How is that a misperception? Explain.
It's a misperception. And because, yes, you are definitely going to be financing that amount you took out to pay off the car in whatever amount of time that your mortgage is. But what you're doing is you're converting a depreciating asset, a car, into an appreciating asset. So everybody, I think, is well aware that when you buy a car for, let's call it $30,000, by the time that you've had it paid off, it's worth maybe $5,000 to $10,000. But you paid more than $30,000 with interest over the term of, that car loan. Where if you convert that over and you can pay it off through refinancing your home and getting cash out, you convert that over to an asset that appreciates, because 5 years from now, your car might only be worth $5,000, but your home is going to appreciate more than $5,000.
Correct.
Plus, You're going to get the monthly payment savings of not having that car payment anymore.
Right, which with car payments today, that can be pretty significant for people.
Certainly. And then you don't have to worry about, defaulting on another payment of some sort.
Right. Well, what about home equity loans? Or is there a difference? But I hear two different terms: home equity loans versus home equity lines of credit. What's the difference between the two, and how can people access those?
Good question. So a home equity line of credit is a second mortgage, so to speak, and it's listed on your title as a second mortgage. So if you look at your title commitment, or who has liens on your property, you're going to see your first mortgage. And then if you took out a home equity line of credit, you'd see a second mortgage. And that home equity line of credit is almost like a credit card on your house, where they do a credit assessment, they do a value assessment, similar but not the same as doing a home equity loan, and they give you a set amount of money on a line of credit that you can use for whatever purposes you want to use it for. And in some situations, that is a good method of consolidating debt, or using money to do other things like home improvements, or you name it. It can go to various different things. Where a home equity loan, you don't take out a second mortgage. It pays off your primary mortgage, sometimes at a lower interest rate, sometimes the same interest rate, just depends. And the difference between what is paid off and the new mortgage is the cash that you get back, that you can use for the same purposes. The great thing about them both is that it's money that isn't taxed. That's yours. But a home equity line of credit is a line of credit, where a home equity loan, that is your equity that you took out.
Okay, I see it. Okay, so the home equity line of credit, you're not tapping into your equity in your house. You're just using it as basically collateral.
Exactly. You got
Okay.
it. You took the word right out of my mouth.
Okay. Is there a difference in the interest rates between the two?
Yes. Home equity line of credit, because it is lending less money, and it is also something that could be considered higher risk by the institution lending it. Because if you have two payments to make, and you know the first mortgage payment is more important than the second mortgage payment, they know that potentially you're not going to make that second mortgage payment over that first mortgage payment. So you're going to have a higher interest rate on a lower amount of money borrowed on a home equity line of credit. Whereas on a home equity loan, you're going to have potentially the same interest rate, maybe less, maybe more, just depends on where rates are at the time. And that's all there is. And you're borrowing that as one whole amount.
Okay. Well, is there like a difference in well, obviously if you're refining and you're taking money out, then it's going to be whether you refi for a 15-year term or a 30-year term. What about the terms on a line of credit?
The terms on a line of credit aren't fixed terms. They're more of an open line of credit. So they can last forever. They can last for a year, just depending on how quickly you pay it back. Is
there a difference on the loan to value that people can access between the two products?
Well, on a home equity loan, whatever your home appraises for, you're stuck at 80%. You can't go over 80% loan to value. So for simple math, if your home is worth $100,000 and it appraises for $100,000 and you owe $60,000, 80% is 80,000, and you'd get the difference between 60 and 80,000, so $20,000 in cash.
Okay.
Where a home equity line of credit is not necessarily based on that same calculation. They may say you owe 100,000 on your home that's worth 150,000, and we'll loan you 30,000.
Okay. Okay. So
you may be able to get more money from a home equity line of credit. You may not be able to. It's just every situation is different.
Okay. But then the offset with that is the rates. What about people refining and or refinancing and maybe changing the term? So a lot of times, I know my husband and I, we refied and we lowered our term because we wanted 15 years and we knew it was going to increase our payments. Are you seeing people refi on a longer term right now so they can immediately experience improve their cash flow?
Well, Sharon, this is actually a very good question, and also kind of difficult to answer right now. And I don't want to mislead people, because you can definitely refinance and shorten your term. Let's say a client of ours is not impacted, their job is stable, there's not a big risk of them getting laid off, and they just want to take advantage of the lower interest rates and go from a 30-year to a 15-year, and their payment virtually stays the same. They could definitely do that. The problem right now is that we all borrow from the same billionaires. Mm-hmm. And those billionaires are saying to themselves, well, we're in a state of crisis where there are 7 million people unemployed. We don't know how far this is going to go and who's going to be impacted. So right now, we don't want to lend money on 15-year terms, because what that's doing is making people pay more than maybe they're going to be able to make in the future. So at the moment, where we were seeing 15-year rates way better than 30-year rates, the difference isn't that much right now.
Okay.
And it's almost it's almost as if they're pricing themselves out of the market, the investors, in terms of, well, we're going to make this available, but we don't necessarily want to make it an attractive offer, because it puts them in a higher risk position.
Okay. Okay. Well, what about just refinancing? I'm just thinking out of the box, some other possibilities. maybe an interest-only loan. I would imagine those would be a lot higher risk right now because you don't know what's going to be on the horizon in a year or so. Are you seeing any of those?
Back when the mortgage crisis in 2006 through 2008, came to a head, adjustable rate mortgages were everybody's scapegoat in terms of this is why we defaulted on our payments. So they became, the hot potato no one wanted to hold on to. And from that, there's still a big negative stigma that is associated with an ARM. So investors have not made that product attractive. They're there. But during this time, there are, if we were to offer a adjustable rate mortgage to somebody, the interest rate would virtually be the same. They have made it to where they don't want people putting themselves on a loan that they're going to have to refinance to a fixed rate later on. So it's an option, but it's going to be hard to find something that's that attractive to where someone's going to want to take that adjustable rate mortgage or interest only loan over a standard fixed rate.
Are there, you mentioned the 2006 to 2008 timeframe. How is this time comparing to the crisis that we saw during that during the banking crisis and the impact it's had on not only your industry but on your consumers?
Very good question. So I've been in mortgage lending from practically since 2003, 2004. It's been a long time. I kind of forget. But one thing that I don't forget is what happened during that time frame. This feels very similar. But, to my staff and other mortgage professionals that have not been in mortgages since that time, who are, uncertain and maybe think that, the sky is falling, it's not. This is different in the regard that was a crisis caused by bad loans that were already in the system. This is different because what it has been done temporarily, we are preventing bad loans from coming in. And when I say bad loans, I'm not talking about, loans that, shouldn't be made in terms of mortgage fraud. I'm talking about where we are lending to, credit challenged consumers,
right,
who, their jobs are in industries that are being impacted right now. So, self-employed borrowers right now, who have great credit scores, they qualify. But one of the things that, may prevent them from getting a loan is if their self-employed business is even able to operate. We've got actually 2 clients at the moment who are self-employed and they own nail salons, and their nail salons are closed. And until they, go back and open up their nail salons, we can't give them a loan. But they've got excellent credit. They've never missed a payment. They've got money in the bank. But we just don't have any proof of the income coming in. So
how frequently is that current proof of income coming in right up to the day of closing?
Yes, it's done actually, 4 different times during the loan process and 1 time after the loan process. So we get a written verification of employment and verbal verification of employment at the time the loan is being processed and gets submitted to underwriting. Then at the time the loan is being cleared to close, we get a verification of employment verbally. Then when the customer is at the closing table, we verify again that same day. And then the other time after the closing, we verify employment when their first payment's due. Because if their first payment's due and they're still employed, but yet asking for forbearance, well, obviously that's not going to be extended. But if they got furloughed during the time and when their first payment's due, they are signing a document at closing that says even if they're laid off before their first payment is due, that they are going to make their first payment, or we're going to have to call the note. Wow.
So you could have had people in the process, because we've been in the shelter-in-place order less than 30 days. You could have had people in the process right up to the day of closing that all of a sudden, what happens to their loans, to their deals? do they lose the option to purchase that home or to refinance? How does that work?
It vanishes instantly. So, I
Wow.
mean, there are 4 different clients, I know their names very well, that unfortunately, one of them decided they were doing a 15-year refinance. And the day that they were at closing, they got cold feet and said they wanted a 30. It's not a push of a button when we, when we change things. New documents have to be drawn. A new approval from the underwriter has to be done, and there's already, the daily minutia of things that are going on. So by the time that we converted the loan from a 15-year to a 30, and docs were released, she lost her job in the day in between.
Wow. Wow.
Yeah.
It's, things are rapidly changing right now. And
yes.
It sounds to me that time is maybe not your friend right now on a lot of things.
It's always a factor. There's always an opportunity cost in waiting. Now more so than ever is a sense of urgency that anyone who's interested in a refinance really needs to take action and not think about what if rates get better. Rates are at a historic low. And 2 months ago, the rates being offered right now, anyone would have jumped on. So this is not a time to be penny wise. You definitely want to take advantage of any payment savings that's available. And I mean, every single company, including our own, we are redlining in terms of capacity. And our operations team, our originations team, our closing teams, I mean, every facet of the industry, industry-wide, is overloaded. We couldn't hire enough people to even accommodate what's going on. And to put into perspective on a real level for everyone to understand is that on the most efficient, best year in mortgages historically, the industry was able to fund $3 trillion. Well, right now there's approximately 5 trillion mortgages that are eligible to refinance to a lower interest rate and save money. But there's also people who are purchasing homes. So if there's 5 trillion in mortgages that are eligible to refinance, and then let's call it 1 trillion of new mortgages trying to come into the market, but the industry can only give attention to 3 trillion, there's obviously a capacity issue. And that's one of the hardest things to balance right now.
What happens when that capacity issue, I mean, how does the market, do the interest rates go up when that happens? Do they, I mean, I'm just curious because
there's
you've got
a little
more
bit
than
of
you can handle.
I mean, supply and demand is always going to come into play. So the liquidity is an issue because there is more, qualified applicants trying to get a loan right now. The thing that we keep in mind for everybody is that we prioritize the business in terms of if someone's purchasing a home, we would say that takes priority over someone who's already in a home and wanting to refinance, where it is important and we want to serve the needs of both customers, but a purchase is going to take front seat over a refinance. And then when it comes to refinances, it's going to be based on first come, first serve. If you're the first customer to get us documents and move forward with the application, well, you're going to get the attention. And the other things that have been put in place to temper the demand are increased credit restrictions. So
can you tell us about those?
Yes, and this isn't every lender is different. I can tell you what our current restrictions are. Where on a conventional loan, we used to be able to lend from 620 credit scores all the way up. And we reduced the ability to lend to clients that are under 640. So we were at 620, but now we're at 640 for conventional loans. And on FHA, VA, and USDA loans, we used to be at a 600 minimum credit score. We're now at a 680 minimum credit score.
Now, do all lenders follow these guidelines, or is there some variation among them?
There's a little variation. Some some are even taking applications on the lower credit brackets that other places aren't wanting to necessarily do the business on. But that doesn't necessarily mean they're going to close.
Okay. What, and the things that you talked about earlier, the things that could cause you not to close, you lose your job, or maybe a final credit check, or those the things that could impact the ability to close?
Well, without getting too far off topic here, or get outside of what our listeners are going to comprehend, there's got to be a investor who wants to purchase the loan. And if investors are not purchasing that loan because of the credit score, even though there's a lender lending the money, doesn't mean that they're going to follow through and close on that loan.
Okay, I see what you're saying. So, well, let me ask you this. I mean, we've talked a lot about refinancing and kind of how that's the pros and cons of that, but I wanted to talk more about how to access your home's equity. We talked about home equity lines of credit, home equity loans. What about reverse mortgages? What are you seeing in that product right now?
So we have a reverse loan specialist here in our branch, and she has literally seen a 300% uptick in her applications.
Wow. Can you tell us how that works?
Yes. So the borrower has to be 62 years of age or older, and they have to have a considerable amount of equity in their home in order to access it. Really what was taking place is the reverse mortgage is essentially lending a lump sum in some situations of cash of the available equity in the borrower's home to them, and they don't have to make payments on the house. So the interest payments that are due get rolled onto the back end of the mortgage. So if you borrow $80,000 and the interest rate is at, let's call it 3%, well, that 3% of $80,000 every single month is going to get added to the balance of $80,000. So over time, the balance that you borrowed on grows, and at the time of death of the borrower, their heirs either inherit the loan and they have to refinance it, or they have to sell it.
Why would someone want to tap into a reverse mortgage right now as opposed to a home equity line or a home equity loan?
Good question. So it is for senior citizens, 62 years or older, mm-hmm. and typically they're on fixed income, whether that be a combination of Social Security, retirement, pension, annuities, or maybe it's just Social Security. And they may be struggling to make their payments to begin with, even before all this. The benefit is that if their heirs are not interested in inheriting their home as an asset, and they decide to do this and they qualify, they're able to not have a payment, as well as access a large sum of cash that they can live off of and not have to worry about monthly home payments.
Okay. Well, what is the process looking like right now as far as, what have y'all had to do in your industry to adjust to the challenges that we're faced with COVID-19?
Well, we are improvising on the fly. That's for certain.
As we all are. Yeah.
Yeah. There's an added layer of difficulty because now we have a whole professional staff working remotely, and things just don't function the same way. Technology, even though is a great thing, and we're able to do what we're doing right now because of it, it still doesn't, translate like we would want it to. Things aren't done as quickly. Where you can simply just go ask someone a question. Now you've got to get a hold of them. Even sending an email, well, when you have, 30 emails of people asking questions, it's hard to address them all. So if you can quantify that into a lot of people doing, things that they typically aren't in their work environment, They don't have the resources they normally have, like even internet speed. The frequency on how quickly these transactions take place is a challenge because we're operating slower.
Right. Right. What about virtual? Are you able to close virtually?
Our bank does not offer the virtual closings. We aren't against it. It's just one of those things that there's got to be a layer of certainty on back end investors that accept them. And if we don't have a large pool of investors who want to take that risk of these online virtual closings, it's not a good business decision. So we haven't been the pioneers in that by any means. And until that pool opens up, regardless of the environment, that's just not something that we're going to offer. But, title companies who close the deals for us have been, doing a great job. All of them have really stepped up and been able to accommodate their customers through, they're calling them curbside closings, where a notary will come to their home and, give them a sealed package with their documents for them to take inside their house, close, sign all the documents, and then bring back out to the notary. The notary does their piece, makes sure that all the documents are signed in the right places, and gets that finished, notarizes it, and then is on their way. That's one thing. Other title companies are allowing customers to come into their offices, scheduled visits only, and are keeping their social distance during the closing and wearing gloves and obviously not making any physical contact. So everybody's different in what their comfort level is. And, these are things that during the process we are discussing with our clients and making sure they're available and have a good understanding on how it's going to take place.
How is the appraisal process working right now?
So thankfully to the, policymakers here, they have opened the funnel in terms of what they'll accept for an appraisal. So they have allowed what are called drive-by appraisals or desktop appraisals, as long as the property does not involve getting cash out of the equity.
What is a drive-by or a desktop appraisal?
A drive-by appraisal is exactly what it sounds like. The appraiser drives by, takes photos of the exteriors only, and then based on the available market data, they put together an appraisal based on that only. The downfall to it is that if they're looking up your home on county records and there's more square footage than what county records is showing, you're not going to get that additional value for it. The good thing about it is speed and how quickly they come back. In a desktop appraisal, the appraiser doesn't even do a drive-by. Everything is virtual, and they basically just assess the market data and give a value. Also, the downfall is still the same. They don't know the upgrades. They don't know the square footage. There could be a pool that if you don't make them aware that it was there and you don't give proof, they can't give you the value for. So it's definitely does still require a little finesse.
Now, we talked earlier about time not being on our side right now and not waiting for the rates to drop. What are the turnaround times right now?
Right now, from start to finish, we are still able to accommodate a loan within 30 days of the time that the application is turned in, as long as the borrower has or is active in supplying all the documentation that is necessary. There's multiple pieces to the puzzle here. And when a borrower provides their documentation, it might peel back a layer of information that we require other things for. So if, typically, if they aren't getting those back in a period of time that we would like, we can still move forward and get things done in a fashion. We've got time. But in this environment, really what's happening, if you're not getting the documentations that is needed, even after your initial round was given to your lender, you may, be working on a loan for 45 to 60 days, just depending on how quickly you do your part.
Right. Okay. Any other options for people right now other than the ones we've talked about? We've talked about home equity loans, just straight up refinancing, reverse mortgages. Are there any other options?
Yeah, one thing that we didn't touch on are the government loans, which are FHA, VA, and USDA, that are currently being serviced, where we call them streamlined loans, where you don't need an appraisal, you don't need necessarily income documentation, and you don't need a lot of the things that standard mortgages need. All that is required is, number one, that you're employed, and number two, you've been on time with all your payments, and there's a maximum loan calculation on each one that is different. But if you fit all the pieces there, and your credit still allows you to qualify for that loan program, you can refinance without having to do all the appraisals and provide documentation.
Is there a downside to that? Are there some additional fees that are involved?
Actually, the downside is very, very slim. The only downside to it is that you're not able to take as much closing costs and roll them into the mortgage. So you may have to bring a payment to close in order to meet the loan calculation guidelines, because each one of them have their own nuances. For example, VA, you have to be able to recoup the cost of the loan within 36 months for a VA loan. On an FHA loan, there's actually a standard calculation that says whatever you owe plus this minus that equals the maximum mortgage that you can take out, where, the lender will do everything we can to, give credits, but the borrower still may have to come to the closing table with a payment, even two payments, to meet that minimum calculation.
Okay. Well, it sounds like you've given us a lot of options. One final question. Are there, on the government loans, are there any restrictions on those right now, especially, with the things that are going on with the IRS, all the governmental agencies that are kind of under the same sort of shutdown orders we are?
You have to be employed. That is the main restriction. And, you have to be current on your mortgage payment. You can't be in forbearance. You can't be behind on a mortgage payment to get caught up. You have to be current, and your credit also has to fit the guidelines for that specific lender.
Okay. Well, final question. I used to hear a lot about subprime loans, and for maybe people who did not have very good credit. What is that even in a market anymore?
So recently, in the past 3 years, the type of loan that was once referred to as subprime was relabeled as non-QM, for non-qualified mortgage, and it became a very big market within a 3-year period of time, and it virtually vanished overnight. Main reason why is because that market was made up of investors who were the majority of them were hedge funds, where they had a large sum of cash, and their investor, their clients were good with the hedge fund leveraging that money to make more money off of mortgages that didn't fit the standard guidelines. But as liquidity came in to be a big issue, and we saw a 28% drop in the stock market, which obviously limits the amount of money that was available to lend out, all of the non-QM investors virtually vanished overnight. So
what about down payment? Go ahead.
So and they weren't necessarily for credit challenged borrowers. Sometimes it was just for the borrower was unable to show income because they're self-employed and had write-offs that they qualified for, and they make more money outside of what they actually file on income taxes. So there were loans that were there for them. Right now, they're not.
Okay. What about down payment assistance?
Down payment assistance in Texas is still available, but those programs have also dried up and aren't as available as they once were. Really, just because of liquidity. I mean, right now there are businesses that are not operating. There's cash flow not coming into the market, and the resources are obviously less. So the state, allocated funds that are there for down payment assistance to put people in homes aren't, though, the most important thing for them at the moment.
Okay. Well, I appreciate all the information you've given us, and it sounds to me like one of the best options that people have is to figure out some sort of way with maybe your assistance to tap into their equity and maybe either refinance or take out some sort of a home equity loan or home equity line of credit to give them some liquidity right now, but also maybe even lower their interest rates, give them something to improve their cash value. So I appreciate your giving us that information. Now, for my listeners, we want to thank Marcus Lepp, and I refer you to his website, www.boemortgage.com.
No,
Nope.
it is. So Bank of England Mortgage, we're nationwide.
Okay.
We're in all 50 states, and our branch is, our website is www.boetexas.com.
Okay, so www.boetexas.com. We're talking to Marcus Lepp, and please reach out to him and look at those options you have about maybe tapping into your equity and getting some help during this hard time, but also be smart about it, and time is not on your side.
Yeah, just one last thing for everybody, if you don't mind sharing, is we've got a superior staff of seasoned mortgage professionals that have been through it all, seen it all. We have a staff of 20 people right now, and all of them have a experience of 10 plus years. There are numerous stories that I can sit around for days to tell everybody on how a client came to us wanting one thing and ended up doing a completely different mortgage. So even if you think that refinancing, getting cash out isn't for you, or that you can't refinance, or you want to, but this is a problem, leave it up to us, the professionals, to let you know what your options are. Don't make any assumptions for yourself. There's plenty of different ways that we can find benefit for you. So if you're interested in saving money through any method, first place to check is with us. Come contact us, visit us on the website, boetexas.com, and we'll put you in touch with one of our professionals and get you taken care of.
Okay, well, thank you so much for your time with us today, Marcus.
And thank you for yours, Karen.
You've been very helpful.
That's what I do. And thank you for your time, and thank you for everybody who tuned in here, and let us know if you have any questions.
Okay, thank you so much. And again, go to his website, boetexas.com.
All right, thank you.
Did I say that right?
You did.
All right, thank you.